Welcome back to Bloomberg Markets. Technology is charging ahead despite economic uncertainty. We have certainly seen that through a surge in tech stocks this year, many with an AI theme. Canada's trying to make a name for itself in the AI world, too. And a lot of that will be in focus next week when the tech-heavy Collision Conference returns to Toronto. Patty Cosgrave is founder and CEO of Collision, as well as Web Summit, and he joins us in studio with a preview. Nice to see you.
Good to see you, John.
We were joking during the break that you guys have a big topic to digest this year, which we didn't necessarily know coming into 2023.
Yeah, it's AI. I mean, the top 10 most favorited talks by attendees already that we can track are, well, 9 of the 10 are on AI. I don't actually know what the other one is on. Hopefully something. And yeah, there's just suddenly a tremendous amount of startups that have raised huge amounts of money with big promises that they're going to transform the world with AI. And there'll be voices echoing that. And there'll also be some, I think, quiet criticism from some of the speakers.
Well, it's astounding when you think about the mood in tech last year versus this year, and certainly for people who invest in the stock market, which is a lot of people who, watch our programming, they did not anticipate all of this money flowing right back into tech, which people have been so skeptical around last year.
Tech has been on a tear. It's incredible in the public markets, but also there was a freeze up last year with venture capital, a huge retreat. And I think in particular with AI, there's a huge number of startups, but there's no shortage of criticism as well that this might just be another frothy bubble, almost a kind of crypto 2.0. So let's find out next week.
We will find out. Yeah, I'm looking forward to hearing some of those panels. Now, the other part of, let's say it's maybe there is some froth, but maybe there's more to it than that. Obviously, that can be transformational for companies, for business globally, but it gets into another complicated web and we hear it here in Canada as well, like who are the companies that control the AI and what is that AI doing? I mean, we know that many governments are very sensitive when it comes to matters around technology today.
Yeah, I think that's a major question. I think it's a reason for some of Canada's ministers showing up. It will be a topic that they'll be discussing. I know you're interviewing several of them on stage. Minister Champagne being one of the more notable ones is the Minister for Innovation. I think he's known as the godfather of AI, Jeff Hinton, will be there, I think, to express some concern. He left Google, I think, so that he could speak in his own words more freely about
and he's been very vocal.
Yeah, very vocal. He has very considerable concerns that there is a heightened need for regulation by governments of these emerging platforms. The European Union has just moved to introduce maybe the first tranche of regulation. There are, of course, voices strongly opposed to any regulation whatsoever. But I think when you have the godfather of AI, Professor Geoffrey Hinton, sounding the alarm, he's at least worth listening to next week.
And you travel the world, and you've built a conference business that it is truly global, so you get to hear a lot of different perspectives everywhere you go. But at a time when it feels like a lot of countries are going inward, do you get a sense that it is this technology story that is sort of at the center of that?
Well, the one story that I've been sharing for several years is just that China behind the scenes is dominating in sector after sector. And I think that's becoming far more apparent. A number of months ago, the Australian Strategic Policy Institute released a report. They looked at the 44 most important areas of technology, and they concluded that China was dominating and leading in 37 of the 44, and actually had commanding leads across many of the most important sectors, and is due to take over first place in all 44 sectors within roughly about 2 years. So to me, that's the sort of dominant meta-narrative that's often not discussed or acknowledged. And I think it will lead to a huge amount of discussion in the West about what policies we either need to change or policies we need to implement to start to play catch up with China, because they have surpassed us, undoubtedly, in areas like artificial intelligence. We might be very excited about what's happening at the moment in the West in AI, but by all reasonable measures that several of these think tanks are using, it appears that China has surpassed the West already and is galloping away into the distance.
Well, there's a constant dialogue. We know in Ottawa the sensitivity around it on the political front, but you even hear it from these major Canadian investors, these pension funds. They all have different strategies when it comes to investing in China. And on the one hand, you don't want to get caught in any political hot potatoes. On the other hand, if they are leading the way, obviously is there something to be learned from that, or are we losing our competitive edge if we're not staying on top of that?
Personally, my strong feeling is that a lot of the backlash towards China is the same as that happened to Japan in the 1980s. In the early 1980s, when Japan started to out-innovate US auto manufacturers, the reaction of the United States was that there was Japanese government interference in Japanese automakers, not as if there hasn't been in US automakers by the American government, and so they slapped huge tariffs on Japanese imports. By the end of the 1980s, the White House was crying surveillance because they believed that NEC supercomputers, which are outcompeting American supercomputers at the time, were a potential national security threat. The rhetoric was all about security, it was all about surveillance, but really it was a reaction to being out-innovated at that time in key sectors by the Japanese. I think what we're seeing today is merely a sort of a Groundhog Day, where the US and several other Western countries are uncomfortable with the speed at which China has out-innovated the West. And we've just got to figure out how to bounce back ourselves and compete more fairly with the Chinese and move away from a lot of this scary kind of rhetoric around surveillance and security, which I just don't think is the issue here. The issue here is we're insecure that we've been out-innovated successfully by the Chinese.
Well, we'll see how that plays out as a conversation at your gathering. We'll see if those startups that are claiming to be the next big thing in AI can really deliver. But you've got a lot of people from around the world that are coming to this conference. And I mentioned earlier, Canada's trying to find its own place in the AI world. A lot of AI talent here. How many people are coming from around the world? How does this all play out?
It's 100 plus countries, more than 30,000 attendees. One of the big changes, the participation rate from blue chip companies. We've got CEOs, CTOs, CIOs from many of the biggest companies in the world, or most established blue chip companies, including Canadian companies like TELUS, for example. And I think they're particularly interested in the possible upside of AI, but also the threats that AI poses to their business. So it'll all play out. It's not just nerds working in startups, it's some of the senior folks wearing suits who'll be at Collision next week.
To get in there. Just a final question for you. As an entrepreneur yourself, you started out pretty modestly. Now you've got this big global conference business. How'd you do it?
A lot of luck. It really started with a number of pub crawls in Dublin. So I organized some pub crawls as a side event to a conference. And one day I met Bono from U2 in a restaurant, and I asked him, would he like to lead one of the pub crawls? And he said, oh, he'd love to lead one of the pub crawls, and he could get a few more musicians and actors. And then suddenly we had these incredible pub crawls. And I remember speaking to Elon Musk to ask him, would he come and speak at Web Summit? And he said, oh yeah, I heard of that, but what about the pub crawl? Can I go on a pub crawl with Bono? And so Elon Musk flew to Dublin to speak at a tech conference, but really he was there to go on a pub crawl with Bono, which he did do and still remembers to this day.
Modest beginnings at the pub. Patty, thanks very much for joining us, and we'll look forward to Collision in Toronto next week. Patty Cosgrave, the founder and CEO.
Well, as we just heard from Brian Platt before the break, the Canada Energy Regulator has released a new report on the future of energy in this country as we move closer and closer to that goal of net zero emissions by 2050. Now, our next guest says that the fuels and technologies that power Canada's energy system will undergo a significant shift, transforming it substantially from what we have in place today. So for more, we're joined by Jean-Denis Charlebois. He's Chief Economist with the Canada Energy Regulator. And when we think about a dramatic shift, Jean-Denis, thank you so much for joining us. I guess one of the things that sticks out for me is the cost. When we think about the financial factors, how do you expect we're going to get there?
The energy mix will change significantly, as our report indicates, in terms of using a lot more electricity, producing less oil and gas, as well as relying on a portfolio of emerging technologies such as more wind power, more hydrogen production, more reliance on carbon capture and storage. In terms of the specific costs, our modeling analysis relies on cost assumptions that are expected to decrease through time, but in terms of what are the specific investments required in terms of dollar amount, our report doesn't go into that level of detail, though.
Fair enough. You know, one of the other things is the level of technology that's still going to be required. What if it isn't fast enough to get us to where we need to go by the time to meet these goals for 2050?
Well, if the technology does not mature as fast as we expect, then obviously the net zero objective for Canada will be compromised. It depends also on the specific technologies, whether it is carbon capture and storage, hydrogen, small modular reactors, as well as, for example, direct air capture. That is an emerging technology to capture carbon directly from the atmosphere. And we've run some sensitivity analysis depending on how cost shifts for any of those emerging technologies. And at the end of the day, if it is a quote unquote a small shift, then other things will need to give, so to speak. But if it's if it's really a compromise in terms of a technology not being available, then there will need to be something that helps Canada meet the goal. Otherwise, something that is already very challenging will become even more challenging or ambitious.
We're looking at a board right now it's showcasing the 3 scenarios and talking about how much oil and gas is expected to decline over this period. Obviously, that in and of itself would have a huge impact on reaching those net zero emissions. But what will be the overall impact on a province like Alberta? Did you get into that?
So what we look for Alberta specifically is the fact that from an energy system perspective, the power generation sector will need to decarbonize even further, and there will need to be more wind, more solar, and also more power generation using natural gas, along with carbon capture and storage, as well as bioenergy. But in terms of less oil and gas production, obviously there will have an impact on Alberta, both from a fiscal perspective, which we haven't gone into that level of detail, but when we see oil production basically peaking at around 5 million barrels per day in around 2026 in a global net zero scenario that we design, and then decline to 1.2 million barrels per day. Obviously, there are important implications, and at the same time, very real opportunities in terms of incremental technology that need to be deployed. I spoke about wind power, and I will also mention carbon capture and storage, which there will need to be quite a bit of that technology in terms of deployment in Alberta and also elsewhere.
You know, this really struck me as a timely report as well. We just had the Sustainable Jobs Act announced recently, and we just had the Natural Resources Minister in Alberta talking to the Premier yesterday. How big of a shift is this going to be when we think about the economy and all the jobs that are required to move in this new direction by the time we hit 2050?
So there will need to be significant deployment of existing and tested technologies and also emerging technologies. I've mentioned a few so far, but in terms of macroeconomic trends, in all of our scenarios, we see the GDP of Canada to be in the positive zone, ranging from about 1.3 to 1.5, 1.6% growth to 2050 across the 3 scenarios. So we see still a number of very real economic opportunities for Canada going forward, simply not necessarily the same as have been in the past.
And wind power, this seems to be an area that you expect to grow by leaps and bounds. In some ways, I was surprised because we see so much solar here in southern Alberta, but wind is somewhere where you're expecting big growth.
Indeed. And at the national level, we expect electricity demand to double, and there obviously needs to be a commensurate incremental generation for electricity, and this is where wind power comes in. Wind power will need about 50% of that incremental demand, and because of the nature of the resource, and specifically in Alberta actually, where wind tend to blow during peak time. There are a few exceptions, obviously, but tend to work well at peak times. Then this means that wind has a very clear role to play in that decarbonization of the electricity sector. again, supplemented by other sources, whether it is nuclear or solar. But at the end of the day, indeed, wind will play a major role across Canada, actually.
Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Lenka Martinek of Nordis Capital to talk about the adoption, Lenka, of electric vehicles, which have really become, just in the past couple of years, it seems, much more than niche products. What do you see as the trajectory here, and what are the implications for Canada? Canada, of course, is recently encouraged by way of enormous subsidies, Volkswagen and Stellantis, to set up facilities in this country. We had to up the ante on Stellantis and offer more than originally offered. And there was a report recently that a Swedish electric vehicle battery company was looking at Quebec, the Montreal area, I believe, as a possible site for a plant as well.
Yeah, so the reason why I wanted to talk about electric vehicles today is because as a sustainability investor, the sort of environmental backdrop has been really tough between the wildfires in Canada, water shortages elsewhere in the world, the likelihood that we're not going to be able to keep the planet from being warming by 2 degrees means that we're looking for positive news here. And one of the areas that I think is a bit of a nice story is electric vehicles. So as investors probably know, individual or cars is a huge transportation in general, but specifically individual vehicles are a big source of GHG emissions. So tackling this through electric vehicles is one strategy. If we look back just even 3 years ago in terms of car sales, only about 4% of car sales were electric 3 years ago in 2020. And in 2023, today, we're on track for about 18 to 20% of all new cars purchased will be electric. I'm talking about globally, not just in Canada, but this is a massive shift in behavior. Most of this is coming from Europe, US, and China, but nonetheless, it's happening in developed markets, developed economies, really all over. And so from an investment perspective, what the thesis here is that as EVs go from something that was fairly niche to something that's quite mainstream, there's going to be a major build out of those supply chains. The parts that are different from sort of ICE or fossil fuel auto manufacturers. So for EV, what that means, it's really the usage of semiconductor chips. So there's in electric vehicles, we use about twice as many chips as in regular vehicles. So we know the demand. We understand why there's a lot of demand for semiconductor chips. And then the other major distinguisher is, of course, the battery and the supply chain related to batteries. This is another area where, unfortunately, fortunately, we talk about this reshoring or nearshoring. There is a massive impetus to get some of these supply chains built more regionally or domestically, if possible. And so, again, right now, as it stands currently, China controls an awful lot of the battery supply chain, and this fiscal push that we've been seeing is really part and parcel of this idea again of reshoring. So those high-profile events that you mentioned in Canada, I think are this sort of almost competition to outdo nations in terms of fiscal policy to attract capital, and that's really what we're seeing. For Canada, I recognize it's probably more of a political discussion about whether the subsidies are the right level or not. But the fact of the matter is that we do have a strong auto manufacturing knowledge here, and it makes sense to build up on that.
Okay, we've only got about 60 seconds left. We briefly showed viewers some of the stocks you like. None of them, I believe, are North American traded. Panasonic, LG Energy Solutions, and Samsung SDI. And you also like the battery recyclers. Can you give us about 45 seconds on those names?
Sure, very quickly. So the first batch of companies are battery producers that don't have ties to China. So they're either Japanese. You talked about Japanese stocks earlier in the segment doing really, really well. So Panasonic, Japanese name, doing extremely well. All of them are basically not tied to less tied to the Chinese supply chain. So that's why we like them. And then from a recycler perspective, again, there's an awful lot of legislation showing that we're going to need to recycle battery materials. So in terms of Canadian names, Li-Cycle is one in the lithium space, basically battery product recyclers that we really, really like. So Li-Cycle and Umicore would be the two names there.
Lenka, thank you a great deal, as always. That's Lenka Martinek. She's managing partner at Sustainable Market Strategies and Nordis Capital, and our featured guest of the morning.
Well, despite a beat on fourth quarter earnings, American restaurant operator Darden reversed its weekly gains, cutting more than, well, you can see there, 3% off the stock. Olive Garden, the Italian restaurant chain, which accounts for nearly half of the company's sales, missed the 5% same-store sales target analysts were hoping for. Let's bring in Sean Dunlop, equity analyst for Morningstar, for some more insight. Sean, thanks so much for making time for us again today.
Thanks for having me on.
So give us a sense of just the quarter as a whole. What really jumped out at you for Darden this time around?
Yeah, I would say there are certainly puts and takes. Obviously, the market didn't love results. Even though analysts were expecting 5% comp, as you alluded to, 4% comp is still very healthy when you take that against just 70 basis points of comp growth across the full-service restaurant industry in aggregate. Darden obviously continues to take traffic share and to take wallet share in that category. So what they've been able to do against a really challenging backdrop is impressive. Now, I think the stock is reacting a little bit to tepid guidance as you look forward into fiscal 2024. We've got 2.5% to 3.5% projected comp growth. You've got implied a little bit of restaurant margin compression over the balance of the year. And you've got an environment where you still see inflation clogging in at 3% to 4% for the next year with very limited pricing power moving forward. So some green shoots continue to take traffic. The firm's pricing approach obviously has borne fruit, and they've remained very disciplined on marketing. They're one of only a handful of operators that have really been able to defend restaurant-level profitability over the last 3 years. But you're balancing that with a really challenging macro environment in the restaurant space right now.
Yeah, there was some weakness in the fine dining part of it, right? I mean, people are do you think that is a sign that people are trading down to some of the other, banners, perhaps?
Yeah, that could be. It's a good question. I think in this case, it probably has more to do with base effects. As you think about it, you're coming out of Omicron, the lab last year, and so you've got a little bit of revenge spending as people are able to go back out and go to fine dining restaurants. That's what's in the base. So I wouldn't worry too much about basically flat sales and the margin compression that follows for this quarter. I would say of the concepts, fine dining tends to be one of the less recession-sensitive segments. It's a more affluent clientele that can kind of spend through the cycle. I would think of it more analogous to luxury goods, whereas some of the more sensitive concepts might be like Cheddar's, where you're competing a lot more on value and where the average consumer might be making less than $45,000 or less than $75,000 AGI.
One of our the Bloomberg reporters pulled out, though, that there's been a bit of a pullback, rather, on alcohol spending, and particularly at the more higher end of the banners at Darden. Is that a big hit when it comes to sales if people start to pull back on alcohol?
Well, it certainly doesn't help. I mean, it's a big part of average check, and alcohol runs 80% gross margins in a lot of cases. It's one of the most profitable menu items. For fine dining, it's almost
80%?
Analogous to, it's very high. Yeah, it's
Wow.
almost like what you would see with French fries at QSRs. So it's not a part of the menu where you want to see people pulling back necessarily, but it does make sense. I mean, again, we're looking at a period in 2021 where people were coming out and were able to dine out for the first time in quite some time. You've got consumers that were mobility restricted and had maybe been reluctant to go out to restaurants, and so they were spending an unusually high amount on some of these indulgences. I think more than anything, we're just seeing people kind of roll that back a little bit.
Now, Darden acquired Ruth's not that long ago, but you noted that you still find this to be a curious acquisition. Can you tell us a bit about why?
Yeah, I mean, strategically, I guess it technically checks all of their boxes. It's a strong brand with competitive unit economics. It's possible that they're able to accelerate the growth narrative. But they already own a steak chain in Longhorn Steakhouse. It's very unusual to see restaurants operate two concepts in the same subcategory, in this case, steak. Even if Ruth's is a different dining occasion, it's competing maybe in some sense with Longhorn. It's definitely competing with Capital Grille. So I was a little curious to see, particularly because, Ruth's is only about 4% of consolidated sales for Darden. So it's not like it's going to move the financial needle materially, and it still costs management about the same as it pertains to like integration and integration risks. But the good news from our perspective and from investors' perspective is that it's not value dilutive. It's They paid about 9.4 times EBITDA, trailing EBITDA, which is lower than the 12.3 times that we typically see in the restaurant space.
And you mentioned the pricing side of things as well, Sean. Darden, we talked about this last time, but they'd been underpricing inflation. What kind of position is that putting them in now when it comes to, if consumers do need to pull back a bit, and the way to get them in might be to offer some sort of a deal?
Yeah, I think it gives you a lot more powder than you would see at restaurants that have taken sort of mid-teens pricing over the last year. And that if Darden needs to pull the promotional lever, they have that in the arsenal. And as consumers are looking for value increasingly, you'll see them favor brands like Darden within the full-service space that offer a little bit more compelling proverbial bang for the buck, if you will. That said, Darden still sits in full service, and the full-service category tends to be quite a bit more cyclical than we would see with fast food, than we would see with QSR. So the net effect of trading down is probably going to be negative for them, but much less than we'd see for a lot of FSR restaurants.
And Domino's that's still at the top of your list instead?
Still at the top of the list. I'm holding out hope on that one. They've got the best four-wall economics of any company in our coverage other than Wingstop. And from the perspective of franchisees, you get your cash of a Domino's unit in about 3 years. So that should underpin the unit development narrative, even in an environment where it costs 20 to 25% more to build a restaurant, and even if you're generating the same level of EBITDA that you were in 2019. So that's very impressive. It also means that you don't have any of those sort of lingering franchisee health concerns. We've obviously seen a couple pretty high-profile bankruptcy cases with Burger King franchisees, and those are the sort of concerns that you don't have to worry about as much with a Domino's.
Right. No, it is a really interesting aspect of it, the payoff part there when it comes to the franchisees. Sean, thanks so much for joining us again.
Thanks for having me.
That was Sean Dunlop, equity analyst for Morningstar.
There were signs this morning that investors are fleeing into bonds, stocks under pressure amid the prospects of higher interest rates. We also got weak economic data from the euro area. So central bankers, they're still hawkish, they're still raising interest rates. What about the risk of a recession? Our guest sees opportunities here for sectors that could benefit from this environment, such as consumer staples, pharma and commodities. We're joined by Darren Sissons, partner and portfolio manager at Campbell, Lee and Ross. Darren, it's great to see you.
Thanks for having me.
Give us your broad thoughts for investing in a recession, because the market's always looking ahead, isn't it, to the recovery?
Yeah, well, I think it really depends on the depth of the recession that we get. I think that most central bankers are probably on the page of a modest recession is what they're hoping for. But I think the challenge is going to be that I don't think inflation is contained, and I think it gets stickier and it gets harder to control. So we may get a modest recession here, but if inflation is not contained, then all we're doing is effectively kicking the can down the road, and at some point we'll have a substantial correction to really tame inflation.
Food stocks, consumer staples, a decent asset class right now?
Yeah, so if you look at a lot of the staples, consumer staples, they've had the ability to pass through inflation, and it hasn't really affected profits. Unilever, I think, earlier in the year was substantial. Nestle, obviously. Those are the types of companies that people are going to continue to buy their products regardless. Pharma, if you need medication, you're going to have to buy it, find a way to do it. Obviously, and commodities are obviously a beneficiary of inflation as well. So those are the types of categories that are going to benefit you. Obviously, risk manage in terms of what you select, but you really want to benefit from inflation while it's present in the system.
You are a keen observer of events in Asia and around the world. Is there a feeling worldwide, if it's possible to generalize, that the economy is relentlessly slowing?
So I think you can start to see in different parts of the world the impacts definitely occurring. Like the Kiwis, for example, are already in recession. The Aussies, their economy is slowing, very tied to China, obviously, commodity demand. And China, to all intents and purposes, is deep in recession. So the question, I think, becomes what happens if China stimulates? What does that do to the rest of the world? And I think one of the disconnects that is very seldom cited is that here in Canada, a huge portion of consumer, government, and corporate debt is effectively variable debt, where in the US, for example, the majority of mortgages are actually fixed at very low levels. Mm-hmm. So higher interest rates in the US are not going to have the same impact they are having in other parts of the world. So the ability of the Fed to get at inflation in the US is problematic.
One stock where people have been watching with disappointment is Nutrien. Those shares have been under pressure. Fertilizer markets stubbornly depressed. How are you playing Nutrien right now?
So at the moment, the stock is under pressure. They've just gone through the annual, obviously the annual contract cycle. And that annual contract cycle obviously wasn't as received as well as it was hoped. So the stock is trading obviously at quite attractive entry levels. But I think if you look at through the longer term view, you've got generally 1% global population growth on less and less arable land, and you have to find ways to maximize yield. So fertilizer is one of those products. So when you can find an opportunity to invest in a world-class asset locally here in Canada that has the ability to benefit from inflation, then I think at these levels it's quite attractive.
What about TC Energy, the pipeline giant? That stock has suffered. Do you see a rally there potentially?
So I think TC Energy is an interesting story. So we're finally starting to get a way to get our energy out of Canada without a US discount. So big tick from a Canadian point of view. Obviously, the Coastal Gas overruns were challenging on the stock. There's obviously an ESG issue that's an overlay. But Coastal Gas looks like it's 90% done. Probably done by the end of the year. Then we can start shipping product to Asia, which has obviously pays higher rates than we get in the US, higher prices. So at this level, the dividends north of 7%, which is attractive in this environment. It's definitely more significant than what you would get if you were put into money market. So this is a safe, steady, well-managed company that's had some issues, but at these levels, it's got an attractive entry level. And obviously, it's a take-or-pay recurring revenue business model, just like, for example, with your Hydro or Enbridge, we have to pay your bill, and if you don't, you get cut off. So corporate consumers will have to be paying their bills. And so from a stability point of view, that's a key. And also there's going to be some asset sales. So at these levels, it's quite attractive.
We'd better jump. Darren, thank you very much indeed for joining us.